And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, the whole enchilada. It's the Lance Roberts Show, presented by Clarity Financial. It's life, money, and sweat equity. Now, welcome in to the Lance Roberts Show.
And welcome to our premiere edition of the Lance Roberts Show podcast right here at realinvestmentadvice.com. Glad you joined us today. We're going to talk about a few things related to the markets, your money, of course, as the markets are now closing. We're going to get you some closing numbers about what happened. Got a few interesting stories today. But today's show being brought to you by our friends over at Witsit Vision Group. Be sure and get by their website, witsitvision.com. Our good friend Dr. Jeffrey McKee is a specialist in improving vision. In fact, I wore glasses my entire life. Now I am 20/15 vision. That's right, lens replacement surgery is the best thing I ever did. But whether it's LASIK or RK or basically fixing some of the issues where your arm's simply not long enough to read your phone anymore, Dr. Jesse McKee over at Witsit Vision Group can certainly do that for you, and we thank them for sponsoring today's podcast as well. All right, let's get into the market wrap today as we talk about where the market's finished. And not surprisingly, after the recent rally at the end of August, which is normally seen at the end of the month, we see window dressing as portfolio managers are chasing performance and wanting to get positions in the portfolio, that here we are the day after Labor Day, a little bit of a sell-off in the markets, nothing dramatic. The S&P closed down about 7.5 points today. And again, nothing to be really concerned about at this point other than after two very strong months. Now, the month of July and the month of August were exceptionally strong for A, summer months, and just B, for the market in general. Don't be surprised if we see some type of pullback or relaxation here in the month of September. This is going to give a couple of opportunities here to potentially increase equity exposure in portfolios. So we're watching that very carefully. You know, when we step back and look at where we've been over the last really 6 months, if you remember, if you're reading our website and of course reading our newsletter at realinvestmentadvice.com, we had reduced exposure to portfolios back in late January, early February. And then beginning in March, we began to add exposure back to stocks and back to markets in general as we began this recovery process of the markets from the basically March lows. Now, the problem here is with the markets now breaking out to all-time highs, A, that's bullish, and that does confirm that the bullish trend is still very much intact, and we certainly want to honor that. But it's also the fact that the markets have now gotten very overbought on a short-term basis. You know, this breakout of this resistance going all the way back to January has a lot of people very excited. And we're going to talk about some of the price targets that are already being put out for 2019. Trust me, very bullish. They'll make you very happy. But if we look at where the markets are on a short-term basis, we are very oversold here and are beginning this correctionary process. Now, it's not going to take a lot to get these markets back to oversold. This is the way the markets have worked here for the last several months in particular. And basically a retest of the recent breakout will likely confirm this breakout and give investors an opportunity to put a little bit of money to work. However, once we step back and look at this market on a longer term trend, and again, as investors, remember our job is twofold. One is to make money and participate as stocks are rising. So we want to certainly understand and honor the bullish trend of the markets. But it's important to understand and remember that stock markets don't always just go up at a 45-degree angle. They do go through periods where they do correct, they do lose a good amount of money, and can set investors back, well, multiple years and longer in terms of getting to where they need to be for retirement. So understanding that this longer term trend is positive currently doesn't mean that it's always going to be that case. And particularly when the markets are as overbought as they are now on a weekly or even a monthly basis, if we step out and look at a longer term, here's a long-term chart of the S&P going all the way back to 2009. As overbought as we are now, these conditions have always set up for a correction. Now, that doesn't mean a major bear market crash. It doesn't mean the world falling apart, although that is a possibility. There's a lot of things happening currently in the markets, whether it's interest rates or monetary policy, economic data. We're basically 10 years into a bull market cycle. All these cycles do end, and we are very late in this game in terms of this current bull market cycle, but nonetheless, the trend is positive currently. And with conditions as overbought as they are, they do tend to lead to a corrective action at some point. Now, when's that going to happen? We don't know. And there's really no way to guess. There's a good possibility that we're going to have a corrective move this month of a percent or two, maybe, that would give you an opportunity to add some money into portfolios, particularly as we head into the seasonally strong end of the year. Portfolio managers are going to be very conscious about trying to maintain and position portfolios for the year-end rally. But the question really gets into where we get into next year. Because once we get into 2019, a lot of things are going to start happening. They're going to be, well, less conducive or less supportive to the financial markets in general. Now, on the website today, I wrote an article this morning talking about earnings and where we are currently as we just have wrapped up the second quarter of earnings for the markets. Now, the interesting point here is that earnings have exploded over the course of the last 2 quarters. And that's solely due to 2 things. One, that's due to the tax cut and reform bill that was passed in December of last year. And the second thing is massive amounts of share buybacks. We have had a record number of share buybacks this year, and that's going to continue to go forward as companies are continuing to try to find ways to improve their bottom line earnings at a time where top line revenue growth not only remains weak, but actually declined in the first quarter of this year. So paying attention to what's happening here to the fundamentals are important because beginning next quarter, in quarter 3, the year-over-year comparisons to earnings are going to begin to decline. While analysts are currently very excited about the markets and saying, oh, we're going to go to 3,300, 3,400 in the markets next year, which would be great, the problem is that has never happened at a time where earnings growth rates are on the decline. And that's going to happen even if earnings continue to grow at the expected pace that they're currently going now. The rate of change in those earnings are going to decline. And that's going to become more problematic for stocks as we move forward because there's simply not the catalyst available currently to continue once we get past the input done by tax cuts and tax reform. There's not a replacement catalyst in position to take that place to continue to expand earnings at the same pace as we saw in the first and second quarter of this year. Also, one other important thing. The one thing that a lot of analysts completely overlook, and we get this from economists as well, just remember this one thing. While the economy's been growing strongly in the first and second quarter this year, lots of expectations for a 4.5% growth rate roughly for the economy for the second quarter. Expectations for third quarter of this year still very high. The reality is that a lot of that has come through the impact of billions of dollars of injection into the economy last year, starting late last year. And really, that money hit the markets this year in particular and the economy from 3 major hurricanes and 2 major wildfires out in California that created billions of dollars worth of disaster recovery. Here, I live in Houston, and we're still in the process of Hurricane Harvey rebuilding. Billions of dollars still being injected into the city of Houston. That's all impacting economic growth in the short term. The problem is there's twofold issues with this. One, it's pulling forward future consumption, and 2, it's skewing the data currently that is going to wind up being much weaker in the future. So pay attention to that. A lot of people have forgotten about that impact of those natural disasters last year. They're attributing everything to tax cuts and earnings, but what we're seeing in the underlying data is a function that these 2 items in particular will begin to fade as we move into the latter part of this year, and most importantly, as we get into 2019, the roll-off effect of these issues are going to become much more prevalent. Okay, what we want to talk about, and we'll take a quick break here in just a second. I want to get into some other stories today related to your money, but as you take a look at this in particular, just remember this one issue. As we go forward looking at the markets here currently, and again, a lot of people are concerned because I write articles that are less optimistic longer term, is that somehow we're sitting all in cash. Absolutely not the case. Our portfolios remain fully allocated at this point or closely there too. And we are looking for an opportunity to add further exposure to the markets here currently. And one thing we're going to start doing on this podcast on a regular basis is not only keeping you up to date on where we are within our portfolios, but we're going to talk about some of our stock picks, things that we're adding to portfolios, positions that we're doing. So the goal here with this podcast is to not only help you be a better investor, but also help you to look for and avoid the risk that tend to catch investors off guard. You know, it's very easy to kind of get wrapped up in the everyday life of things, and when markets are going up, we just assume that, well, that's always going to be the case, and if you listen to the mainstream media, that seems to be the majority of the message that's actually presented out there. Don't worry about it. Just put your money in. It's going to go up. It's going to be great. But the problem is that that's not the way the markets work. That's not the way investing works. We have two primary goals as investors, which is A, to grow our capital, but B, not to lose it. You know, Warren Buffett had a set of rules that were very simple to follow. Rule 1 was don't lose money. Rule number 2 was refer to rule number 1. And that's very much the case. So as long as we understand kind of what we're doing and what we're looking for, it makes a much easier process for managing the risk in our portfolios. And that's going to be a primary focus of this podcast. I hope you'll stick around for our next segment, and we'll keep you up to date on not only the markets and the money, but I got some great stories coming up as well. I'm your host, Lance Roberts. Follow us at realinvestmentadvice.com, lancerobertsshow.com. You're listening to The Lance Roberts Show right here at realinvestmentadvice.com.